Hello, I'm Asif Farouk of Finextra and I'm here at EBA Day 2015 in Amsterdam, and today I'm with Falk Bräuning of the Tinbergen Institute and the Free University Amsterdam. I'm going to speak to Falk about a research paper he wrote for the Swift University with Dr. Francisco Blasts and Iman van Lelyveld on interbank lending. So Falk, thank you for joining me.
Good afternoon, it's my pleasure.
So credit risk uncertainty was a very big part of your research. Can you tell us more about that?
Right. So we developed a model of the interbank lending market, in particular of the unsecured interbank lending market, and due to unsecured nature, credit risk is a major factor in these markets. And we looked at uncertainty about the credit risk, about the asset value of the banks, and view this as the major explanatory variable in describing the market developments during the crisis, and also the cross-sectional market structure when we view of this over-the-counter market as a network. So this is really the key underlying factor in our model.
Right, okay. And you also mentioned earlier that interest rate corridors played a major part of your research. Can you tell us what you learned about those?
Right. So in our model, basically, banks want to exchange funds to smooth so-called exogenous liquidity shocks. They result from their day-to-day business operations, like they need funds to make a payment, or they have a surplus of funds because some customer deposit money at their accounts. And these liquidity shocks, they must be smoothed out, that's how we call it. And for smoothing out these liquidity shocks, basically the banks, they have two alternatives. One is they go to the market, to the over-the-counter market, and they contact counterparties and see if they can strike a deal bilaterally in the over-the-counter market, in the over-the-counter interbank market, or that's the second alternative, or they go to the central bank, which provides facilities for lending and for depositing money. And the price of liquidity by the central bank is basically defined by the interest rate corridor, where we have two different interest rates. One is for depositing money, and the other one, which is above the deposit rate, is the rate for obtaining funds from the central banks. And so these outside options provided by the central bank, they are really crucial in determining the market structure and the incentives of banks to privately go to the market and exchange funds on a one-to-one basis.
Great. So finally, are there any conclusions you can draw from this project you've done?
Right. So in this respect, what we find is really that the outside options for interbank lending, which in our model are exclusively given by the central bank's standing facilities, they are really crucial for, as I said, for determining the market structure and the market dynamics. For instance, when we solve our model and we bring it to the data, estimate the parameters, and then we analyze the estimated model, what we then find is basically that if the central bank narrows the corridor, the interest rate corridor, which is again the difference between the interest rate for obtaining funds from the central bank and the interest rate from depositing funds at the central bank, when the central bank narrows this interest rate differential, what happens then is that banks have less of an incentive to go to the market to engage in private interbank lending. So in that respect, our model, which is a mathematical model, so involves a lot of assumptions, but within our model, narrowing the interest rate corridor actually hurts the market activity in the sense that there's less trade going on, the total volume decreases, and so forth. So in that sense, if private policymakers, or public policymakers, if they want to encourage private interbank lending, then one strategy would be basically to make private interbank lending more attractive. And this can be achieved within our model by increasing the interest rate corridor.